What is going on, guys? It's Spicy here. For those who are in crypto right now, I hope you're having as much fun as I am with this bull run. Because, yeah, I'm not going to lie, the market has been pretty generous recently. Anyway, so every now and again, a few people come into my DMs on Twitter or Discord asking me how I trade. And whenever I say that I have a systematic style of trading, some people get confused or just don't know what that means. So I thought I would start making some YouTube videos on it. And my plan is to make a lot of videos on the topic, which are short and easy to understand. And I thought that would just be better than dumping everything into one long, boring video. So yeah, let's jump right into part one of an introduction to systematic trading. Alright, so yeah, before I could get into the video, just want to do a quick risk disclaimer. Trading is very risky, you can lose all your money doing it, blah 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 blah. Alright, so first, I just want to quickly talk about the two main styles of trading. So there's discretionary and there's systematic. So first I just want to jump through what is discretionary trading, because I think this is the most common style among new traders. So discretionary trading is mainly about just using your gut feel or your intuition to make your trading decisions. So most people start off with stuff like technical analysis, uh, news, fundamentals, or anything else to help them create like a narrative for where the market might go next. And then they might be a little bit more strict on how they execute their trades. But at the end of the day, most of their trading logic is based on the idea of I think the market is going to do this next, so I'm going to trade it like this instead of like that. Whereas systematic trading, on the other hand, is using a very strict and rule-based system to help you make your trading decisions. So basically, a certain set of conditions must be true in order for you to enter the trade, and a different set of conditions must be true in order for you to exit the trade, whether that's exiting for a profit or exiting for a loss. You might have a different set of rules for either the two, or it might just be the same set of rules. Obviously, you can make it as simple or as complex as you like. Doesn't really matter as long as you're making money, right? So it could literally be as something as simple as, when the market opens on Tuesday, market buy, and then close the position when the market opens on Wednesday. That could literally be your strategy. Or it could be something as simple like, if the RSI is greater than 80, then market buy and then close the position after 14 candles, right? So the point is where you think the market is going next. It doesn't actually mean anything to how you trade. It's not related to how you trade. And that's because you're following a strict system. So even if you think the market is going to go up or down or whatever, so let's say you think the market is going to go down. If your system is saying you have to get long, that means that you have to go and get long even if you're currently bearish. So of course there are people out there who have like a hybrid approach and try and take the best of both worlds. That's fine. That's totally okay. But me personally, I just prefer being fully systematic. So fully rule based, no discretion, no opinion at all. Alright, so why? Why is discretionary trading just not for me? So it's not that discretionary trading is bad. On the contrary, it's actually an extremely powerful trading style in the right hands. But because of my personality or because of the way that my brain is wired, I can't seem to perform well using my discretion. So when I first started trading, I think I started like everyone else. I was just using my discretion completely, like 100% discretionary, and I was relying on technical analysis with a bit of indicators here and there. But then I noticed that when I started leaning more towards a systematic style, the more consistent my performance was. And also last year in 2020, I wanted to give my discretionary trading another shot, and I got the opportunity to work for a prop firm, which and that firm really encouraged discretion. But yeah, sadly, I couldn't make it there, and it just didn't work out. And I think the reason for that is because naturally, I am a very, very emotional person. Um, and I have a history of really extreme impulsive behavior. And I think I spoke about this in my last video, but basically, if you have shit going on in your life outside of the market, outside of trading, it's really difficult to execute your trades properly. So, like, I've had to see multiple different psychologists to help me with my issues. And I actually started seeing one as well while I was at prop because I had an incident um, in July, which was pretty fucked up. And yeah, so anyway, I had way too much shit going on, and that was basically in the way of my improvement as a discretionary trader because all of my effort was focused on fixing who I am as a person rather than fixing up my trading. So obviously you want to be in a good state of mind, or you don't want to have shit kind of being an obstacle to your trading if you want to take this the discretionary approach. Okay, so why is systematic trading most suitable for me? So, like I said in the previous slide, I am mentally and emotionally fucked up, right? But despite this, it can't actually affect my trading performance at all. So how I feel when I sit down to trade, it has no impact on my performance because all I'm doing is buying when my system says buy and sell when my system says sell, right? If you're discretionary and you have a shit day and you sit down to trade, obviously you're going to trade like shit. But if you're systematic, if you have a shit day and you go and sit down, it doesn't matter. As long as you're following your strict rules, you don't really have too much room for error unless you decide to counter trade yourself, right? So yeah, the point is, even if I'm going through an episode, it doesn't matter as long as I'm following my rules. Um, yeah. So also, before I was trading, I was actually involved in an online gambling business on a video game called RuneScape. I'm sure a few of you have heard of it. And I don't really want to get into specifics, but long story short, I was basically taking bets on a fixed 50% win rate, but my risk reward was always at least 1.1 or higher. So over the long term, I'd be making money. And it didn't matter if I thought I was going to win or lose the bet because um, as long as I'm just taking a bet that I have odds in, that's fine. Easy peasy. And also, it's a lot easier for me to sit through drawdown. So when I was losing trades using my discretion, I'd be taking a hit not only to my P&L, but I'll also be taking a hit to my ego. So after every loss, I would feel kind of stupid or dumb because I couldn't calculate if the trade that I took was a positive expectancy trade or not, right? And that's okay. I mean, you have to deal with that if you're discretionary, but basically, my subconscious automatically assumed that after every single loss that I took, oh, I was just gambling on negative expectancy trades. Obviously, this isn't the case, but that's how it felt like at the time. And that would actually make me tilt insanely fast, and so much of my effort was used on preventing tilt and other preventative measures rather than paying attention to the market and paying attention on my own trading. Um, but the thing is, when I lose a trade with a completely systematic approach, it doesn't feel anywhere near as bad because I just take the hit to my P&L and move on. And that's how it's supposed to be. You take the hit to your P&L and you move on. And my ego didn't really feel like it's taking a hit at all. I don't feel that because I already have really high conviction and really high confidence in the idea that all of my trades that I'm taking, they have positive expectancy. So all the drawdown that I have to take on, it's fine, it's natural, and it's totally okay. Next point. So it's easier for me to set goals and learning objectives for my improvement as a trader. Okay, so what do I mean by this? Whenever you want to improve at anything, whether it's a sport or a video game or trading, you want to be constantly setting yourself reasonable learning objectives and goals. So as soon as you reach that goal, you've leveled up as a trader. So with discretionary trading, the goals that I would set myself would be pretty vague. And an example would be like, I need to puke my positions faster when I'm offside, or uh, if I'm feeling if I'm starting to feel like I'm getting mad, I need to stop trading quicker. I need to identify that I'm getting mad quicker. So that's just two examples, and it's pretty tough to actually track how well I'm progressing on that goal. Whereas with systematic trading, the goals that I set myself are pretty simple and straightforward. They might be hard to achieve, but they're very simple and specific and straightforward. So for example, go backtest this moving average strategy on Bitcoin, or go test what times of the day most of the volume comes in on Bitcoin. So boom, as soon as those tests are done, I've leveled up as a trader. Even though my P&L is no different, it doesn't matter because I have an increased awareness on the market that I'm trading. So a lot of the goals that you'll be setting when you're a systematic trader, they basically, not all of them will immediately impact your P&L. A lot of them will just give you an increased awareness or just give you more perspective on the market, on the specific market that you're trading, or maybe a little niche on the markets, like how the volume comes in or where the volume comes in. Or maybe it's something about volatility or an indicator. It doesn't matter. It just gives you more information. And then over the long term, you can use that information to build maybe a new edge, and then eventually it affects your P&L. So for example, right now, one of my current learning objectives is to learn how to code. And that actually brings me to my next point, where it's possible to automate all of your strategies so that while you're sleeping, your system can still make trades for you. So like at the moment, if my alerts start going off while I'm asleep, it means that I have to get up and get ready to trade. And if I choose sleep over trade, it means that I might miss a setup. So you can imagine how fucking annoying that could be. Also, automating your trades has huge benefits because instead of spending your time on trade execution, you could be using that time to just be doing more market research or figuring out another way to try and improve your edge that you already have. Okay, so what is my goal as a systematic trader? And it's actually a pretty straightforward goal. So I want to create a portfolio which runs multiple strategies with low correlation to each other in order to achieve or create a smooth equity curve. So that means a portfolio of strategies which trade different markets, different styles of strategies, whether it's trend following, mean reversion, arbitrage, whatever. Maybe a different execution style and different time frames. So yeah, if you're trading a whole bunch of different things at the same time, you're more likely to have a smoother equity curve. And also, if one of those strategies happens to die early, you don't have one point of failure. And you have like a more robust portfolio. So in case that didn't make sense, I've visualized it here. So here are 10 hypothetical strategies which all have the same statistical win rates. I can't remember the stats that I used off the top of my head, but I think it was something like the maximum loss for a month was 20%, but the maximum win for a month was 25%. And I used a random generator to plot 10 different simulations, 10 random performance outcomes for each strategy for each month. So this is just a random hypothetical year. So you can see that even though all 10 of the strategies, you know that they have the same performance metrics, but you can see that over this random year, some of them did really well and some of them actually lost money. So if you were only relying on one or two strategies in your portfolio, boom, you could have lost money. This light green equity curve, that could have been your equity curve, right? But the thing is, if you spread your risk out evenly between all 10 strategies, even though they have the same performance metrics, you can see that you get like an averaged out equity curve. And yeah, I would much rather this equity curve, than having to gamble and pick on just one of these. This is obviously much more consistent because it's an averaged out version of all 10 of these combined. Wow, I had a mental blank there. Okay, so to emphasize my point, here I've got 30 strategies. Again, they all have the same performance metrics. And you can see here, if I compare the red line is the equity curve of the 10 strategies, and the blue line is the equity curve of the averaged out version of 30 strategies combined, right? So ignore the fact that the blue one made more money. That's not what the point is. The point is, pay attention to how much more smoother the blue line is over the red line. Jeez, I'm losing my voice here. You can see that the dips in the blue line are a lot less steep than the dips in the red line. And even though the red line, the red equity curve, has steeper winnings as well, you want to be looking, or you want to have a portfolio which has a smooth and consistent looking equity curve. So yeah, it's nice to have huge green months, but if that's also accompanied by having big red months, then it's not really that great. Ideally, you want to have a pretty consistent performance overall. I would much rather have a lot of little green months and then barely any red months at all, rather than having huge green months and huge red months at the same time. So yeah, in conclusion, systematic trading allows your emotional behavior and your life outside of the market to not directly impact your trading performance. Even though it can impact your ability to learn and improve as a trader, if you have a shit day, it's highly unlikely that you're going to fuck up that day if you have a completely systematic approach. Because, yeah, all you have to do is follow your strict trading rules. And it's just like programming, it's just based on if this is true, then do that. And finally, you just want to be able to create a portfolio which is running a lot of strategies, preferably with as little correlation as possible, and make sure that you are diversifying the risk between the strategies that you're running properly and accordingly. Because obviously, you don't want to be chucking a whole bunch of risk on some strategies which are correlated and then cry and complain when they just happen to lose at the same time. You're like over leveraged or over risked, right? All right, so I'm gonna wrap up the video here, and I do, like I said at the start of the video, I did want to keep these videos short and concise because I didn't really want to bore you guys too much. And this video is just part one of many more videos to come. And since this one was just the very first introduction to systematic trading, I just wanted to talk about like the basic things, just like what it is. And in the coming videos, you'll see me talk about a lot more advanced topics, and hopefully you guys can learn a thing or two. But yeah, basically this video was just to address a lot of the questions that I got from, I guess, starting traders or newer traders. Yeah, if you enjoyed the video, feel free to hit the thumbs up button and subscribe if you want to see more of my content. And yeah, comment below if you're a systematic trader or a discretionary trader. I want to see who I've got following me, or maybe you're a hybrid of the two. And yeah, you can connect with me on Twitter or Discord. I'll leave my socials in the description. And finally, if you guys want to get 5% off your trading fees, then make sure to sign up to FTX using my ref link, which is also in the description. In my opinion, FTX is the fastest growing exchange right now. And in my opinion, it's a valid contender to eventually become the best crypto exchange in the world. And the reason why I think that is they're constantly building, improving, and adding new products to trade. And it's not like they're just some random new exchange out there, which has fuck all liquidity. There's actually plenty of liquidity there. So if you're trading with more than 100k on Binance or Bybit, you won't really feel too much of a difference if you're on FTX. Yeah, I think I've said everything. Got my shills out of the way. And yeah, I hope you guys enjoyed the video. There will be plenty more to come. So yeah, stay tuned. Hope you guys enjoyed. Peace.